What kind of people, what kind of institutions tend, and I know that it's still a growing industry and part of our role can be as evangelists to get more demand out there, but currently, what kind of individuals and institutions tend to be interested in this? How do they get started? What types of vehicles? You've mentioned microfinance. We've talked a bit about some structured products. Do you see the mutual fund obviously is a very common entry point as way people get started, and how do the rookies tend to look at this? Give some specific examples if you can, and then as people progress and get more comfortable, what kind of things do they tend to be focusing on?
I can discuss from Parnassus' perspective. A large number of our clients are direct shareholders, so they just go into parnassus.com and open an account, $2,000 minimum. So that's about as easy of an entry point as you can get, I guess, if you want to look at it that way. We go all the way up to large foundations, private banks that are working with large foundations, and generally speaking, there's going to be a gatekeeper in there, so a consultant or a large private bank will have their own in-house research group to do this work. And that's really going back to my previous comment. That's us getting in there, talking to these consultants, and convincing them that we can deliver them an attractive return. And that's really the big issue for a lot of our kind of our larger clients. Maybe these guys can speak more into where people go after they've kind of dabbled in the mutual fund world and want to go a little bit deeper.
I mean, I would say, and this is self-selecting in the sense that people often come to us when they're trying to figure out that entry point, and the right answer for a lot of them really varies. And I think that we've seen, and to some degree, a lot of it is when people get stuck on public equities, because for some folks it's easy, it's liquid, it's accessible. There's a wide variety of choices, including some good ones. Sometimes people just get stuck on that, and it's like, okay, we got to find something else. And so, I think it varies. Large foundations, we tend to find it's very, very, very mission-specific stuff. So for them to change their investment process to do things that are kind of aligned with their mission, as they say, the juice is not worth the squeeze. However, to do stuff that helps them improve their core business of philanthropy, makes them a smarter grant maker, a better policy advocate, and is so in touch with their mission that it helps that's what often gets them rolling. So it's less about the asset class, it's more about investments that have a tight enough alignment with their mission to get them going.
Can you give some examples in the foundation space?
So I'll give a couple examples for Kellogg, which is sort of a good illustrator of that. So Revolution Foods. We did a mapping exercise of 36 segments in the food space, which is one of Kellogg's areas of programmatic interest, narrowed it down to the top 4 segments, the top one of which was healthier school lunches. And so finding a company that had healthy school lunches for low-income kids that also informed their policy conversation with the administration about school lunch reform. I mean, that for them is the killer solution. We invested for them in the only for-profit Head Start provider in the country. They have super lean overhead, invest in their curriculum, thus their money goes to pay their teachers better. They pay their teachers 40 to 60% more than the failing Head Start programs they're brought in to replace. They're sort of a Head Start turnaround shop. Once again, it informs the policy conversation that the foundation has. And so that's the kind of alignment that works for large foundations. For family foundations and smaller foundations, it's more, we got to do more with less. We're not that big. We got to use more of our resources. And there, often it's working with their financial advisor or consultant to find an open space in their asset allocation for something that's going to make the financial advisor happy. It's going to pass muster from an allocation perspective, from an integration perspective, but is much more in touch with what the family or the foundation wants to do. Individuals, often we see they either want to just carve out some money, so people show up and say, here's $10 million, I want to experiment. I want to learn, I want to try some things, and I want to try some market-oriented things, some less market-oriented things, a wide variety of stuff. Community foundations sometimes want deep community work. So for San Francisco Foundation, we did a pilot of a green affordable retrofit housing product with a leading affordable housing developer here in the Bay Area, a loan to folks that do kind of alternatives to payday loans in the Bay Area, or folks want to invest their corpus. So what RSF Social Finance does with its options, some of the things Impact Assets does with their options. Silicon Valley Community Foundation does that, what Schwab does with some of the things. And I think it really, once again, just not to be wildly unhelpful, but kind of finding that contextualized entry point that really meets the circumstances and the goals of the institution it's just super important. And I wish there were sort of the one-size-fits-all or even one-size-fits-most approach. But I think, in our experience, the good news is there are a lot of great choices, and it's just finding the right way to get rolling.
Yeah, so I think to dovetail to John's comments, in my experience, there's no shortage today of opportunities, almost irrespective of the thematic issue area that you're interested in, whether it be people, planet, climate change, economic empowerment, education, health. The issue comes about in the structure of how the product is built, and particularly the issue of trying to democratize it for what I would consider to be a retail client audience. So that's what we've been trying to do at Impact Assets. So today the world's kind of bifurcated. There's a couple of great options if you've got $1,000. One is the Calvert Community Investment Notes. They're actually offered by a partner firm, Calvert Foundation, affiliated with the Calvert Mutual Funds. And they offer some great solutions. Also, there's an eBay affiliate called Microplace. And Microplace has a listing service in which there's a number of different thematic issue areas represented. But beyond that, if you look, for example, at the 50 managers on our list at Impact Assets 50, the average minimum investment for those 50 managers is just south of $1 million. There's a few that accept investments at 100, a few more at 500, many at $1 million to $2 million. So that's out of reach for what we see is really the target market, is hundreds of thousands of Americans that might be interested in putting 2, 3, 4, 5% of their portfolio this direction, but that 2, 3, 4, 5% is not $500,000. So we're trying to build out a series of products at Impact Assets that address that $25,000, $50,000, $75,000, $100,000 opportunity and do it in what we think is kind of a sweet spot that's today currently not addressed.
So several different on-ramps available. Many of you may be familiar with something like Kiva. So that's an on-ramp for your donation money. And essentially they loan it out to micro-entrepreneurs around the world, comes back, and then you can reinvest it. And you get to actually interact with, again, what's important to you. Is it somebody around health? Is it somebody around creating wealth? Is there an earth impact? Is there an equality impact? So that's easy. So that's out of your own donation money. Larger foundations do something called a PRI, program-related investment, where it's not just a grant flow, it's a debt or an equity flow. You have to keep a lot of paperwork for the IRS to prove that you're not blending your corpus money and seeking to make a profit that's not going back to the mission, but that's a potential option. So then what do you do with your cash? So you can seek out banks that actually do something that has positive impact. What do we do with positive impact? Oh yeah, so with positive impact, and so someplace like New Resource Bank or One California Bank takes that money and reloans it out for solar loans for your home, or into environmentally focused businesses or social capital businesses. So that's a second choice. What we find among some higher net worth investors is because traditional banks are not lending money to entrepreneurs, they're actually going out and being the bank. So they're doing venture debt and working capital and lines of credit, either directly with an entrepreneur that they vetted, doing the work that the bank would otherwise do, or with an entrepreneur that they know, taking investment assets and putting them up as collateral, so you're getting sort of a double duty for your portfolio. So you could get not an upper end of maybe 100% impact, but 200% impact. If you took impact-oriented assets, put them up as collateral for a bank, that bank loans it out to an entrepreneur. Now you can get 2 units of impact for the price of 1, possibly. So on the risk side is there are some really attractive private equity or real estate or natural asset investment opportunities that are investing in a diverse entrepreneurial community around the world, but have, say, no women on the board of their investment company. And again, this is where you, as the owner of your own money, need to ask questions about where that's going. And so there's essentially research that shows that things like the more women on a public company's board of directors, the more financial success it tends to encounter. And there's some recent research that just came out that said the more women on a team, the more collaborative that team and the more productive that team. So much so that that particular professor even said, what's the optimum size for a team? And they said 100% women. So at HIP, we would give that negative points because we believe in a 50-50 gender equality, but so be it. That's our blind spot. And so by asking these questions as the investor, saying, how many women are on your team? What's your decision process? How are you integrating environmental, social governance concerns? You are voting with your own money. And smart investment managers will listen to that. And blind investment managers, those without impact glasses, are going to encounter more risk and less opportunity.